Okay, welcome everyone to April market review. First of all, let's go through the overview summaries first. Equities and bonds plummeted in April because of worsening inflation, and as a result, there's a rise in yield. This actually is because of a dampened expectation of the Federal Reserve rate cuts. Second point, dimensional equity funds actually underperformed against the indexes because small cap was not doing as well due to the rising yields. And finally, on the third point, I just want to cover the series of major economics equity landscape that we are covering since last month. And this month, we will be looking into China's equity landscape, the largest single country exposure in the MSCI Emerging Market. Okay, let's dive straight into the April performance. Well, as mentioned, in US, rising CPI inflation levels actually led to the rising yield because the market expect the Federal Reserve to be less likely to do rate cuts this year. And as a result, we are seeing that in US, companies who are facing higher borrowing costs, and S&P 500 in April saw a fall in their performance at roughly about 4.1%. And of course, we know the negative correlation between prices and yield. Rising yield means that the price in bonds actually fell. And Bloomberg Global Aggregate actually fell by about 1.61%. Now, how about in Europe? Well, in Europe, Nestle and Kering, the company Kering, actually also fell due to disappointing earnings. Just to give an example, Kering, the parent company of Gucci, is seeing a slowdown in sales in China, and as a result, that actually affected their bottom line. Now, if we go into UK, things are more rosy because, for example, the FTSE 100, which tracks the top 100 UK companies, has risen about 2%. This is primarily attributed to the companies of commodity and energy companies. BP and Shell, the energy giants, actually see a price rise in performance for 5% and 9% respectively. And the commodity giant Rio Tinto and Glencore actually registered a performance of about 7% in April. This is thanks to a rise in energy and commodity prices rising to record levels. Now, if we go further east, in Japan, they are also seeing a huge fall in performance. Nikkei 225, the index that tracks the top 225 Japan companies, fell about 5%. Now, why? Because the rise in US yield actually led to a fall in Japan yen against the US dollar. And as a result, that actually brought worries that the rise in import costs for Japan will bring about worsening inflation within the country. And this might dampen domestic demand and cause companies to see less earnings on their bottom line. So as a result, you can see that the developed market MSCI World IMA Index actually fell by about 3.9%. Now, if we go to the emerging market, we can see that from the chart, the emerging markets actually rose about 0.67%. Why? Because this is mainly attributed to China doing quite well, supported by China's stock market regulatory. They actually provided some support to encourage local Chinese companies to get listed into the Hong Kong Stock Exchange. Now, on top of that, China also saw a GDP growth of 5.3% in 2023, and this actually beat market expectation, and this helped to drive the emerging market higher, and therefore we can see that relative to the developed market, emerging market is doing much better. Now, if we go to the next slide, dimensional equity funds. Well, as I mentioned, the rise in US yield actually did worse caused smaller cap companies to do worse off. Now, this is due to their more sensitive reaction to higher borrowing costs. And as a result, you can see that dimensional global core equity, which mainly have a developed market with a small tilt towards smaller cap companies, register a higher fall of 4.22%, while the emerging market and the dimensional the emerging market risen by about 0.5%. Now, this is in contrast to the rise in the MSCI Emerging Market of 0.67%. Now, if we look into dimensional world equity, which consists of both that developed market and emerging market, it has fallen about 3.75%. So, it is just to keep in mind that as the data on inflation in US keep coming in, the market will keep adjusting these price levels and price in the possibility of the Federal Reserve, whether they will do a rate cut or not. So what this means is that going forward, as inflation data keeps coming in May, June, July, so on and so forth, you will see that the market will move more volatile because of this inflation data. It is so important to ignore these short-term fluctuations and rather look at the long-term economic fundamentals. Now, next we are going to look into the China equity landscape. And first of all, I just want to highlight the importance of China's equity landscape. Now, the much referred to, often used as benchmark, and for funds, the MSCI All Country World Index, short form ACWI, consists of both developed market and emerging market within its constituents. And for the weight of the emerging market, since 2001, its weight has been only 5%, about 5% within the MSCI Equity. However, over the 20 years from 2001 to 2020, the weight has actually risen to 12%. And this is mainly attributable to the China's rise. And as a result, for a globally diversified investor, an investor with a globally diversified portfolio, it's crucial for them to understand China, the single country with the highest weight in emerging market. We understand that there are a lot of factors impacting China's equity market, and however, for our April market review, we'll be focusing on a more recent event, which is the China real estate crisis and its impact on the China stock market. Now, the collapse of Evergrande, one of the biggest developer in China, actually sparked a real estate crisis. And before the collapse, housing prices has been rising steeply, and developers has also seen a rise in debt as well. And on top of that, data from the People's Bank of China has shown that 90% of the China household already own a home. Additionally, surveys have shown that most of the houses that are being owned is showing evidence of non-occupancy. And this means that the rise in housing prices is more speculative than market demand based. Now, if we look at the contribution of property market and affiliate industries to China GDP in 2020, the real estate and its affiliate sectors actually contribute more than 20%. And China household survey also show that 70% of China's family household wealth is tied to property. So what this means, if a collapse in China real estate prices, it will have a huge negative impact on the financial system as well as the welfare of many Chinese. So on August 2020, the central Chinese government actually implemented the 3 red line policy. And this 3 red line policy aims to reduce the debt interest coverage for developers, of course, reduce the debt levels for developers, and finally also boost liquidity. Now, this actually lead to Evergrande, which already settled with debt, to face even more liquidity crunch. And finally, on November 2021, Evergrande actually was delisted from the Hong Kong Stock Exchange. And during this time, from the implementation of the August 2023 red line policy to the time when when Evergrande was actually delisted from the Hong Kong Stock Exchange, the Hang Seng China Enterprise Index, which tracks Chinese company listed in Hong Kong Stock Exchange, fell by over 40%. So now let's next assess the ripple effects of the real estate crisis in China. Looking into the banking sector, now the China property loans from 2011 to 2022, the loans given by the bank to the residential mortgages and developer loans has risen from below 5 trillion yuan to all the way to almost 40 trillion yuan in 2022. Now, however, if we assess the performance of the top 4 banks in China, which has about 20% weight in the Hang Seng China Enterprise Index, the performance of the top 4 banks since the implementation of the 3 red lines policy in August 2020, has not been very material. In fact, 2 of the top 4 banks actually experienced 30 to 40% cumulative increase in their stock market prices. Now, however, this is not to say that this might not be an issue, because in 2023 annual report, the total amount of bad loans reported by the top 4 banks has risen to about 1.23 trillion yuan. That is an increase from 2022 of 10.9%. Now, but despite that, the net profits for the top 4 banks has not been materially impacted yet. And nevertheless, it does not mean that there is no lingering effects from the real estate crisis. In fact, in the KKR report, which we will discuss later, the evidence have shown that the China real estate crisis has not yet been fully realized. Now, before we go into that report, let's next go into the local government debt, which is the next ripple effect that we'll be talking about. So, looking at the chart, you can see that the Chinese local government land sales, since the implementation of the 3 red line policies in 2020, the increase of the land sales in 2021 has been very minimal. And since then, the land sales has been going downward sharply to 4.2. So this means that local government are seeing lesser revenues into their coffers. On top of that, local government financing vehicles, a kind of debt that is used to finance local government infrastructure projects, has also been rising sharply. Now, because the LGFVs, the local government financing vehicle debt, is an off-balance sheet entity, information about how huge the debt is has been opaque. But based on PIMCO's estimation, the debt level at current time is about 55 to 60 trillion yuan. And the main holders of these LGFVs are insurers and banks. And if the LGFVs were to default, these banks and insurance company will have to write down these assets, and this will in turn impact their share prices and have cause huge volatility in the financial sector. Okay, next, let's look at the potential further corrections in the housing market landscape, which I mentioned just now, that the housing market correction in China may not be fully realized yet. Now, there will be 3 charts that I'll be going through. And first chart, what we are looking here is a chart called the housing start chart. In this chart, you can see that we are comparing with China with 4 countries. and that will be Spain, US, and Japan housing starts. What housing starts mean is that it is the number of residential projects being ongoing at a specific period. And using these timelines, shows the peak of the housing starts for the respective countries. And you can see from the y-axis, the peak starts at 100%. And for example, if you're looking at the Spain housing start, the timeline T, which is the peak of the housing start, it starts on 2006 and it starts to come down. Now, if we look at China, the timeline being 2019, it started to fall for about 5 years, and the housing start actually fell about 60%. And the 60% fall, it was only within 5 years. In comparison to other countries like Spain, US, and Japan, we can see that their time period is actually longer. And even the shortest one, US for example, the housing actually keep falling till T plus 7. In other words, even if we compare to China to US, there might be an additional 2 years of a correction for China. Now, if we go to the next chart, looking at the housing investment, similarly, if we compare the timeline versus Japan, Spain, and US, for China, it has only fallen so far by about 25%. In comparison, the longer period of US, Japan, and Spain, they have all fell by 48%, 56%, and 68% respectively. So this does show that the housing investments in China might continue to fall further. Now, finally, and most importantly, the chart on the housing and land prices. Again, you can see the peak of the land prices in China has only, in comparison to the other countries, and has only begun to fall. And we are seeing that despite decreasing housing activity from the investment and the housing starts, the China existing home price doesn't seem to have fallen much. So what this means is that there could be a further housing correction based on KKR's analysis. Now, let's look at the next point, the negative wealth effect that is caused by the real estate crisis on the equity market. Now, just let me explain what the negative wealth effect is. It is an effect when the decrease in household wealth actually lead to a decrease in consumer spending. And because most of China's wealth, 70%, is tied to property, a decrease in the property value actually leads to them feeling less financially secure, and therefore they decrease their spending. And this decrease in spending can actually generate a deflationary environment and also cause consumer confidence to further come down. As a result, companies might actually see less sales and therefore impacting their earnings. If we look at the China inflation rate from May 2023 to April 2024, since June 2023 till January 2024, we see a few series of a deflationary trend, which is represented in negative values of all this. And you can see that the highest deflationary period was actually on January 2024, which is negative 0.8%. This means that month on month, price levels have actually fallen by almost 1%. However, since January 2024, we are actually seeing a more positive trend, which is that inflation actually has risen in February 2024 and March as well as April 2024. Now next, let's go into something more positive and more optimistic, which is to see that there are indeed actually evidence of positive trends in Chinese consumption amid all these economic challenges. Now, if we look at the China retail sales growth from January to February 2024, you can see that the total retail sales in these 2 months actually was about 5.5%. Now, within this 5.5%, 4.6% was a contribution by the retail sales growth, and 12.5% was a growth in retail sales food service, and as well as a whopping 44.4% was contributed by air passengers. Now, this actually shows that post-COVID, now Chinese consumers are actually now going more holidays and going for tour. Now, if we boil down into the retail sales of goods, we can see that auto vehicles have actually contributed quite huge, as well as the electrical vehicles, which risen by about 37%. Now, complementing this positive economic activity, the China household savings rate has also increased from 29%, which is the historical average pre-COVID, to about 31.7% from 2020 to 2023. And on top of that, to put things into perspective, if we look at the retail sales during these years, right, the retail sales in China is actually 47 trillion, while between the period of 2020 to 2023, the amount of savings that is amassed is actually more than the retail sales in 2023, which is at 56 trillion yuan. In fact, analyses have shown that if China consumers' confidence revived and the savings goes back to historical average, the amount of savings that's being amassed here will go into the economy, China economy, and help boost China's economic GDP. Now, on top of that, I also like to highlight that despite all the geopolitical tensions that we are seeing in China and the Western developed market, China exports to the Western countries has actually grown by about 7% in the first 2 months. And notably, with the US, it has actually grown to about 5%. While it is still too early to claim that China's equity going forward will be all rosy, it seems that it is going in the right direction. Now, coupled with supportive policy measures from the central government on the Chinese stock market, as well as very encouraging macroeconomic indicators coming out of China, we can see that as of January 2022, when the stock market year-to-date has hit rock bottom, since then, the equity market has actually risen up to year-to-date of an 8.8%. Now, in the final section, we will be looking at factors beyond the real estate crisis and identify the potential major drivers of China's economy. Now, in fact, a report has actually shown that 40% of China's GDP growth in 2023 was actually, in fact, attributed to clean energy sector, which actually shows that China's dependence on the real estate sector has actually been greatly reduced. Now, if we look at the China's 2024 GDP breakdown, an estimation by various government sectors, they have shown that the forecast on digitalization and green transition totals about 5% of GDP growth for the year of 2024. While they see that real estate and scarring, in fact, scarring means that the lingering effects caused by COVID and the real estate crisis will have a negative impact of negative 1.4%. And overall, in fact, we see that despite this negative 1.4%, the digitalization and the green transition actually offset this negative, and they estimate that there will be about a 4.7% growth in 2024. Let me just summarize on the China's equity landscape and the key takeaways. Now, first of all, the long-term investment strategy. So despite the real estate crisis in China and their short-term market fluctuation, it is still crucial to maintain long-term investment strategies in China's equity market due to its growth potential and resilience. Now, on top of that, the crisis has not had a significant material impact on China thus far. Now, secondly, the economic diversification in China. The housing sector correction offers a chance to China's dependence on real estate for GDP growth, promoting investment in sectors like green technology and innovation, which can, in the long run, drive a sustained economic growth and competitiveness. Now, finally, diversification benefits. In fact, historical data highlights the importance of diversification in investment strategies. And although developed markets have outperformed emerging market recently, past periods such as 2001 to 2010 showed significant returns from China, emphasizing the need to diversify to mitigate risk and optimize long-term returns. Now, I'll just pass over my time to Joyce, who will be doing the market debrief. Thank you so much.
So thank you, Tun Shong, for the very comprehensive market review. My name is Joyce, Client Advisor at Providend, and I'm here to give you a market debrief. So in recent years, we have seen a lot of market volatility. So today, I'd like to take this opportunity to discuss the importance of proper asset allocation in line with your financial goals, risk tolerance, and your time horizon, in addition to a diversified portfolio. These two charts show you the two extremes, the year-by-year return of 100% bonds and 100% stocks since 1973. So looking at the returns of stocks below, you will notice that most of the years are positive, but there will be periods of time that is negative. And the negative return can be quite distressing for most of us. So if you take the dot-com crisis in year 2000 as an example, an investor would need to be able to sit through 3 consecutive years of declines before benefiting from the next 5 years of positive returns. And after the 5 years, we encounter the global financial crisis in 2008, so which the stocks is down of about 41%. So you will then notice that there can be quite a bit of turbulence during an investor's journey if you invest in 100% stocks. However, if you look at the bond returns at the top, the returns are pretty stable. For example, if you notice that the 3 major drawdowns in the course of history, equities went down a lot, but bonds went up. And during the difficult times like this, they serve as a cushion to the volatility the equities bring to your portfolio. And when we see that the fall of our portfolios are not as bad as what the media shows, we are more able to keep calm and stay invested. So depending on the return that you need and the time horizon that you have, this slide may be more reflective of the likely ups and downs of your portfolios, using an 80-20 and 60-40 portfolios as an example. If you recall from the previous slide, in 2008, 100% stocks portfolio was down to 41%. But for the portfolio that has only 60% stocks and 40% bonds, it will fall. But instead of 41%, it fell to 20%. So that is why in your wealth plan, we have already taken this volatility into account. So what I meant was only for goals with longer time horizon of at least 8 years, we will then recommend you to have at least 60 equities so that you can have 60% equities so that you can have enough time to ride through the volatility and at the same time be rewarded with a higher average return. So in this slide, I will show you the trailing 10-year returns for someone who had invested at some of the worst times since 1973. So if you look at the 4 boxes over here, each of them starts with a major drawdown. Then at the bottom chart, it shows you the annualized return after 10 years for the 60-40 portfolio and 80-20 portfolio. So as you can see, all these portfolios are positive despite starting at one of the worst times. So we don't know whether if the market will soon experience a big drawdown, but we do know that from the history and evidence that even if you do, you have enough time to ride through the market and to ride through for the market to recover eventually. So now if you look into the history of how often market downturns occur, you realize that they are not uncommon. Fortunately and unfortunately, most market drawdowns are within the range of 0 to -5%, and it is also not uncommon to experience a market drawdown of -5%, which is -10% above. So a 10% market correction happens about once every 2 years on average, and a 20% bear market happens around every 6 years. Especially when you are invested for a long run, it is important that we are prepared when they come. So through this discussion, I hope that it gives you comfort knowing that if you have given enough time, you will be able to ride through the volatility as long as you stay invested and also stay diversified, meaning to say that you invest in a diversified portfolio, not concentrated in one or two stocks. You will be able, with enough time, you will be able to ride through the volatility and be able to capture the return that you need. So I've come to the end of my discussion. If you have any questions about our discussion today, please reach out to us.